The markets get a nice little bit of optimism as the week begins, but ultimately do very little with it. That's if you ask equity markets, but movement is certainly afoot elsewhere in the macro universe. Bonds are higher, the dollar is lower, and a strange bit of life has emerged into one of the most unloved markets over the past 2 months. The euro manages to climb from the lowest in 2 years. The question we're going to be asking ourselves on this shortened week with very little to do on the US side as things wind down for the holiday is, can we maybe get some action in the euro and the currency markets this week? This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to take a look at how it was that the euro got here and what happened to give us this move, and then consider where we might get the catalysts for this to continue. And the place that seems to make sense to start is first and foremost the positioning itself. So if we take a look at what seems to be going on here, the first thing that comes to mind is that we're looking at a situation here where the euro seems to have found an important inflection point. Take a look. This is 6E futures here, the active contract, and we had a appearance of a clean technical break last week. There's that area there marked by the March and the October lows from last year at about 104.80 to 105.30, let's call it. So centered within about 20 pips this way or that around the 105 figure. That's this right here. We stalled at that level in this long 2-month decline for the euro that was ultimately characterized by what was going on the US side of the ledger rather than anything with the euro per se. And of course, that story ought to be a familiar one. It really has the most to do with what's been going on with a reshuffling of Fed policy expectations. And as ever, we see this is something that we've unpicked quite extensively over the past several weeks, but we'll do it again to make sure that our context remains in place. We've had now basically the better part of 2 months where the market essentially took the mid-September Fed policy announcement and said all of the dovishness that seems to be on display here is probably going to be inflationary in the context of an economy that is at this point not looking especially weak. And that then creates a situation where we've seen a lasting rise in the dollar, a lasting move higher in yields. You can see that very clearly here. Again, a bit of a busy chart, but one that tells a clear-cut story. At the top here, we have inflation expectations as baked into bond markets, break-even rates. These are the difference between nominal and real interest rates. We have a steepening of the yield curve shown by the uninversion of the 10 to 2-year yield spread. We have a clear-cut march higher since about the middle of September in yields across the curve, the twos, the tens, even the long end, and of course, a strong rally in the dollar. All of this to say, the Fed is giving us a 50 basis point rate cut. They're telling us that we're going to get 150 basis points in further easing beyond that. Meanwhile, the economy is growing between 2.5% and 3% annualized. This is not the kind of situation where aggressive stimulus is going to leave inflation as it stands. Rather, this is something that is likely to crimp the Fed's ability to ease in 2025 because their actions now will be inflationary. And so against this backdrop, you get an extended decline in the euro against the dollar because the dollar itself is on the move. You get a kind of crescendo in the story last week with absolutely abysmal Eurozone PMI data. And that's what you see right here. There is the expectation that the economy will put in a modest second month of standstill. As ever, PMI data is centered around the 50 level, where 50 is neutral, neither expansion nor contraction. Above 50 is expansion. Below 50 is contraction. And the expectation was that for the second month in a row here, we can see there's October at 50 on the composite index that subsumes both services and manufacturing, that we'd get another month right there. What we end up with is a dramatic slowdown in the service sector, which falls back into contraction territory, 49.2 against expectations of well over 50, and that takes the composite down aggressively and gives us the worst outcomes that we've seen essentially in a year almost. So what we're looking at is deeply disappointing economic data, and not surprisingly, the euro behaves accordingly and jumps all the way down here to probe under the 104 figure and hit this low from May of 2022, which is the next sort of major inflection point there, 103.62. And then the markets rebound. Not because of anything that happened on the European side necessarily, but rather because the dollar takes a big step back as bond yields cool off today, seemingly around the news that President-elect Donald Trump has nominated Scott Bessent, a longtime macro hedge fund manager, alongside the likes of George Soros and Stan Druckenmiller, who's built his own macro hedge fund that's been successful for decades now, to the post, very influential post, of Treasury Secretary in the new incoming administration that's going to take the reins early next year. The market's seemingly taking that as a positive sign, as an indication that there'll be a steady hand at the till, as it were. Scott Bessent, whatever you may think of his opinions this way or that, or what ultimately becomes the policy that he executes this way or that, is certainly somebody that's intimately familiar with the machinery of global financial markets. And so he is a very experienced hand in the role that he is being tapped for. And of course, in having run a business, he's also run a somewhat complicated organizational structure, and that is a relevant skill set to running the Treasury Department also. Not a perfect skill set, of course, not exactly the same, but after all, what is? And so with that in mind, the markets seem to look at this and said, okay, this is on balance good news. And so a degree of sovereign risk around uncertainty linked with this nomination seemed to come out of the bonds today. That pulled U.S. yields lower and gave the US dollar a little bit of a knockback in that it tightened its yield advantage against other currencies. Very tellingly, the euro does not make a key breakout here, but comes right to the underside of where it broke down last week and holds right there. So the key question from here is, are we now done? Is this rebound over? Or perhaps do we have scope for something a little bit more significant? Even something like this, a bit of a wiggle higher here, maybe toward the 106 figure or something of the sort, to relieve some of the recently aggressive selling, and perhaps then and only then set the stage for the next leg in whatever this larger decline is going to look like. And an argument in favor of a larger bounce, in particular this week, begins with a look at incoming Eurozone CPI data, which is expected to show, for the first time in a long time, a sizable back-to-back bounce. The expectation is that we're looking for a year-on-year inflation number at 2.4% year-on-year. That would be the highest that we've seen Eurozone inflation since July, and the second consecutive increase, which is not something that we've seen in quite some time for the Eurozone. So the ingredients seemingly are there for at least something that doesn't make the euro situation worse after that extrapolated 2-month sell-off. In fact, if we look at the makeup of the situation in the euro area, we see that, at least as far as the latest numbers are concerned, most inflation continues to linger in what you might say are discretionary spending categories. Miscellaneous, obviously, is a difficult thing to make heads or tails of. There's a hodgepodge of all kinds of things in here, but the real big lingering influence is hospitality, restaurants and hotels. And one might reason that with the economy clearly doing this, that is to say, shrinking once again after an aborted attempt out of recessionary conditions earlier in the year, that discretionary spending will go with the business cycle. And as the business cycle now gives you a cool down, so too discretionary inflation will come in, because the discretionary spending will be crimped. If we look elsewhere here, there's really not a significant concern. And indeed, there's not much that needs to be undone. If a full 50 percentage points of October's inflation number is being contributed by hospitality, you could go quite a long way toward the ECB's target 2% by even trimming that in half. And so, with that in mind, the pathway forward for the ECB seems unmistakably dovish any way you slice it. In fact, if we look at expectations as they appear in benchmark ESTR futures, we can see the markets see 22 basis points in further easing baked in through the end of the year. So that's about an 88% chance that we're going to get another cut in December. And then about 100 basis points, that is 4 more cuts, are priced in for next year, which is almost double that which is currently in the forecast for the Fed. So that the euro is looking at a significantly more dovish rates profile than is the dollar, that much is clear, and that the structure of inflation suggests that bias won't change, that too seems clear. In fact, we can see here what's happened with the current evolution in policy expectations is that here's September, then of course there's October's rate cut from 3.5 to 3.25%. The pathway since then has only become moderately more dovish. And so what we have here is a shallower sort of curve currently than what we saw when the ECB last met or the time before. So with incoming information, the markets have only become more convinced in a dovish ECB. And frankly, with the economic data the way it's been going, rightfully so. So how does all of this comport to a euro bounce? Well, the question, as ever, is what has this information done for us lately? All of this is ostensibly in the price already. There's really not much that isn't already reflected in a euro sitting as low as it is after this extrapolated decline. So which part of that story is not in the exchange rate already? Well, a disappointing inflation number, perhaps. However, we look at the way that Eurozone economic data has performed relative to forecasts since late September, the trajectory has been toward improvement. That's not to say the data has been good. In fact, the PMI numbers last week are a shining example of data that not only wasn't good, but surprised down, not up. But on the whole, we can see that over the course now of almost 2 months, Eurozone economic data outcomes have improved relative to forecasts, and in sitting above zero on this Citigroup index, narrowly suggests that the path of least resistance, or at least the place where surprise risk is concentrated, is on the top side. If that gives us a somewhat warmer CPI number here, that may be enough for the euro to find speculative exhaustion out of sellers, where they look at this extended move and say, well, sure, the ECB is going to cut. It's almost all the way baked in already. There it is. 22 out of 25 basis points of a cut are already there. Not much room for anything else. We know that there's already an extensive rate cut cycle on the menu for next year. Were we to get a very weak CPI number, maybe that number could move out. But if we got a pop, at the very least, there's nothing there to make that 105 basis points look like 110 or 120 or 130. If nothing else, it stays as is. And so the question becomes, well, which part of that isn't in the euro a hair from 2-year lows? And if in fact the surprise is on the other side, as the recent dynamics have suggested, PMI of course notwithstanding, then we have a situation where you might have the catalyst for the markets to say, you know what, there's been a lot of speculative money to be made short the euro, and maybe that window has closed for however long, until there is not a new catalyst to shift the balance. And that may be enough for a round of speculative repositioning, if nothing else, which could be just enough fodder to give us a euro back above this barrier here, resting somewhere in the vicinity of the 106 figure. And to the extent that that looks like a reversal, it may yet have follow-through potential, at least in the near term. Moreover, the dollar side of the ledger may actually be somewhat helpful. Obviously, we've had 2 months of this already. We are looking at some reinforcement of it, first with minutes from November's FOMC meeting, where, as we looked at in detail last week, there seemed to be a more hawkish admission sort of rhetoric from the Fed, where they seem to dilute the more rabid dovishness of September and say, well, looks like the markets are angling toward a reheating of the economy. Just so we're clear, we don't intend to jettison our 2% inflation target or declare victory in a premature way. We're not in any kind of hurry to cut. We heard this reiterated in a speech from Fed Chair Powell a week after this meeting. Then later on Wednesday, we're going to get U.S. PCE inflation data. And here, the expectation is for a pop that would essentially give us a fourth consecutive month without disinflation on the Fed's favored inflation gauge, the core PCE number. But of course, these numbers tend to be relatively easy for the markets to forecast, as we have the situation now with the same period's CPI and PPI numbers already in the books. It's relatively simple for the markets to back out what PCE probably looks like from those releases. So the level of surprise risk here seems moderate. If the minutes from the Fed don't essentially give us anything more hawkish than we already know to power this narrative to new extremes, and if the PCE numbers register somewhere within striking distance of expectations, yes, that of course will suggest that the Fed is probably going to be restricted in terms of its easing cycle. In fact, we can see that here, the high frequency annualized rate, the 3-month annualized rate here has actually been going higher for PCE over recent months. And of course, September saw a meaningful month-on-month increase, suggesting that indeed the Fed is going to have its hands somewhat tied next year, or more so than even they anticipated. But we've already seen that accounted for here. And so what we need to see is something truly remarkable. The minutes would need to say something nobody has bargained for yet, which seems unlikely. And the PCE numbers, would have to wildly overshoot expectations, which is, of course, possible, but again, unlikely, given the market's track record of forecasting PCE with CPI and PPI in hand. So, absent a hawkish surprise on the dollar side, and with a bit of a supportive wiggle from Eurozone CPI on the other side, what you may well end up with is all of the fuel you need for a euro correction. Not for any reasons of structural change, but just of speculative exhaustion. And that is macro money for today. As ever, we are usually here Monday through Thursday, but only today and tomorrow this week because of the closures in the U.S. for the Thanksgiving holiday. We come right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. On a typical week, I'd be on with Victor Jones for The Price of Truth on Wednesdays, on with Chris for Futures Power Hour Mondays and Fridays, though not this week, and writing for the news and insights portion of tastylive.com. That continues. And finally, opining sporadically on both the platform formerly known as Twitter and on Blue Sky at Ilya Spivak. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow.